I think yesterday we were right on the money and actually right on the week. If you go back to what we spoke about earlier in the week, we were expecting a little bit of a choppier back and forth type action, and we got it. And I just want to recap why, because calling stuff out and making sure we all understand why is a completely different animal. I want to make sure that we are all awesome, for lack of a better way of putting that, at identifying the setups and why those setups lead to a particular type of um, what we call trade expectation, for lack of a better way of putting it. It really boiled down to a lot of stocks were still longs. There's not even a question. A lot of stocks were still longs. But what changed the scenario was the fact that a lot of those longs were running out of room to go. And that was what really influenced my thought process last Sunday night into Monday morning, and especially, obviously, giving a call for the week. And I would really like to see everybody else start to do that, both in the market as well as in their stocks. And you can see very clearly here what we were discussing in the Spider, because we had resistance here, resistance here, resistance here. So there was a lot of upside diminished. No, there's really no other way to put it. We did get a little bit of a Fed boost the other day and whatnot, that big green candle on Tuesday, but that's been it for the week. I mean, if you pull out the announcement on Tuesday and you look back at what we expected for the week, we're pretty much spot on. And again, it's not magic. I'm not saying I'm smarter than anybody. What I want to do is just make sure that everybody understands how to put those pieces together. And I really feel that the way that we've been discussing it together, where we discuss order flow, then we discuss momentum, and let's get clear on momentum. It's basically well bid or well offered on the daily candles, closing positive, being above the previous day's high if everything is perfect, setting up the trades that way. So you got order flow, you got momentum, then you throw into the mix, where are we from day 1 through 3 versus days 4 through 6, and then you add room to go. So you have all of that criteria, and then you drop down to your intraday time frame and you start to look, okay, which stocks right now match my higher time frame, and which ones are now currently giving me a good risk spot, risk location, however, acceptable risk to you, I guess that's the only way to put it, and then you take the trade. The one thing I do want to discuss that it seems to be coming up in a lot of the coaching calls is the distinction between being disciplined and trading your strategy versus the context where some people are taking that as that means you need to trade less. And I can absolutely understand why that might be the thought process, but I also want to explain that is 100% the wrong idea. I don't want to say thought process, because it's the idea. Being disciplined and following your plan doesn't mean you should be trading less. It means that you should only be trading ideas that match your strategy. It doesn't mean that you should not take all of them. As a matter of fact, it means you should trade more when you have ideas that follow through. So just for example, let's just say, for argument's sake, I'm trading these top 5 stocks in here. Let's say I'm trading MDVN, MPLX, ACAD, HES, EGN, IBM. Let's say I'm trading this group of stocks, right? So let's say the market opens, and let's say, for argument, just for argument's sake, keeping it as clean as possible, let's just say, for argument's sake, these stocks are on my long list. They match all of the criteria of I want to be long. And my immediate criteria, let's just make it as clear as possible. Let's say the criteria is at 940, whichever stocks are above the opening price and net positive, I'm immediately buying with the stop loss at today's low, just for argument's sake. So it's a little bit exaggerated, but it's really not. So the point I want to make here is, and you should have this in your mind, if you have 5 stocks that trigger and match your strategy, you should take all 5. I can't explain that more succinctly. Now, before you type in, well, my buying power is not what it, I can't do that. My buying power, I completely understand that. That's not the point. I'm not talking about buying power. I'm talking more the global concept of allowing your probabilities to play out over as many good trades as possible, as fast as possible. And I know that word fast is a little bit, it implies that we're over trading. And that's really the kind of thought process they want to get across here. It's not over trading if every trade you take matches your strategy. That's the best. That's the point. Okay. And too many traders mistakenly believe if they take every trade that matches their strategy, they're over trading. No, you're not. And it's a metaphor, or actually analogy is the best word here. It's an analogy that I rarely like to bring up, but it absolutely is perfect in this scenario. If you go into a casino, let's pretend you go to Las Vegas or Atlantic City or whatever it happens to be, and you'll walk in to the casino. There's not a chance in the world you are going to see one blackjack table, one poker table, and one slot machine. Why do you think that is? They have a slight edge over time, and they want to get to the point where they apply that edge as often as possible. That's how those machines work. That's how the casinos make money. They make money on that slight edge, and they want the amount of money they make. It might not be on a gigantic edge, but it's an edge that they want to play out over time over a large amount of samples. So the greater the amount of times people hit that wheel, or the roulette wheel, or pull the handle for a slot machine, or sit down and play blackjack, or whatever it happens to be, the edge might not be monstrous, but the larger the sample, the more money you're going to make, provided you're disciplined on the downside. So I can't stress that enough. Trading a lot is different than over trading, because trading a lot, if you're trading your strategy, is the correct thing to do. And the reason I'm bringing this up, this is directly from my own trading experience. This is not something that you're going to read in a book or anything like that. I will tell you flat out, when you believe in your strategy, you have to start trading it with consistency. Then when you start to see you have consistent P&L, your number one goal should be to trade more, or trade every single. Better way to work. Trade more implies you're not being super disciplined and just don't want to trade more for the sake of trading more. But what I mean is, once those two things are in place, you've proven it works and you've proven it can follow it, you should trade every single signal. So if you have 12 to 15 stocks in your list every day, and you have, again, I don't care what anybody's buying power is. That's not the point. Some people are trading props, some people aren't. You should trade every one of those signals to get to a larger number of allowing your edge to play out. And let's just think about it in sample size. Let's just say, for argument's sake, if every time you have a winning trade versus a losing trade, the net profitability is, I'm just going to throw a number out there. Let's say it's $5. Your net profitable after commissions, losses, and everything over $5 for every time you place a trade over time, because you put in your winners, you put in your losers, but you're only trading your strategy. You should want to trade more, because if you know over time the edge is going to keep producing $5 per trade based on the averages, you should want to trade a lot, because if you trade twice, you're going to make $10. But if you trade 10 times, you're going to make 5 times that amount, from 2 trades to 10 trades. So it was brought up in a conference call. It was brought up by somebody who said, I want to be disciplined, so I'm going to trade less. And I understand where that comes from, but it's wrong. It is absolutely wrong. You are not over trading if you are trading your strategy. I cannot emphasize that enough. And the last part of that equation that basically comes into play is that once you believe in your strategy, once your strategy proves itself, the last thing for you to believe is in probabilities over time. So essentially what that means is, I believe my strategy will make money over time. With consistency, all I need to do is not mess it up. So that essentially translates into, you will now never, ever hesitate entering or exiting a trade, because the individual trades don't matter. What matters is the results over time. What matters on a trade-by-trade basis is you flawlessly executing your edge. So I think that is an incredible thing that came out of the coaching call, because it's not spoken about enough, that once you find your edge, you want to trade the hell out of it. You want to get to the point where you're taking every single trade. And again, within the context of your buying power, I get that. That's not the point. The point is, you need to have that mindset that if I believe in my edge, I must take every single trade. And I'm going to tell you right now, When you get to that point, all of the pressure of trading is lifted off of your shoulders because individual trades don't matter anymore. Whether you made money or lost money on an individual trade, and especially, I guess, for newer traders who haven't proven to themselves they can make money, all of the pressure comes off of your shoulders in a dramatic way because now it's not a matter of I lost money on that trade. Oh God, why me? Oh my gosh, I'm the only person on Wall Street who loses money. It doesn't matter anymore. Because now you're like, no, that loss was a business expense, and I know if I make 100 good trades this month, I should end up on the right end of the stick if I follow my plan. I said should because we got to take ourselves and put ourselves in the equation and follow it flawlessly. So that's I wanted to make sure we ended the week on a really good strategic mindset thing. And that's something that every one of us can take into the market every single day. Now, the only thing that will prevent you from accepting that belief, and I should say those series of beliefs, the only thing that will stop you is that you don't believe in your strategy or you don't have one in the first place, which means that you need a little preparation work before you can believe those strategies, because the amount of intensity that you will believe something has a lot to do with your experience prior to accepting that belief or the preparation you've done to mentally accept it. So if you don't accept that belief, that just means that you need to work on your plan and you need to define exactly what you're looking for and then trade the heck out of it and see what the results are. So I thought it was a great way to end a coaching call yesterday, because the person I was speaking to just brought up something that I almost jumped out of my seat, and I was like, no, that is the wrong thought process. And hopefully that call can benefit everybody today. You know, there's actually a quote from Reminiscence of a Stock Operator, which I think probably is influencing what I had said before about the SPY, because we're actually seeing it here now in Goldman Sachs as well. We get a push higher, we get a quick pause, we get another push higher, and we get a flag, right? So everything is good up till that point, right? Perfect. Then we bounce out and we don't go higher. We basically just go up for 5 or 7 minutes there and we don't go higher. So the quote from Reminiscences of a Stock Operator is, the rallies grew feebler and feebler. So technically you're still making highs, but each successive rally is going higher with less movement. So in other words, let's say the first move went up $1, then the second move goes up 80 cents, and then let's say the third move, even though you're technically making new highs, let's say that last one only goes up 30 cents. So the rally is getting feebler. So it's you're actually pushing higher, which is signaling that although you're making higher prices, there's less institutional activity behind that. And that's what we saw in the SPY here on these last two pushes, and we also just saw in Goldman. So really good example of learning how to read deeper than just reading the fact that you're going higher. And it's actually why the end of day recap from, like when you watch CNBC and whatnot, it can be deceiving because you could technically be closing strong, but if you look on the daily charts and see how much stronger you're closing compared to the recent pushes, you start to get a feel that, and actually feel is not the right word because we don't want to trade on feel. You start to get a real good reading on what price action is actually doing. So you could technically be going higher, but going higher with less institutional activity. It's just a really good way to read the tape. And it's not that you shouldn't be long anymore. It's that you shouldn't be adding and you shouldn't be getting aggressive. And generally speaking, that will technically happen on days 4, 5, and 6 of a move. But you can clearly see here again during these pushes, we're not getting the move higher either. So you might be getting up to day 4, and then intraday you start to see these kind of moves. So it's interesting.